If you walked onto the factory floor of a legacy cardboard box company today, the most powerful person in that room probably isn't the grizzled plant manager who'd been there for 30 years.
Right. Which is what you'd expect.
Exactly. Surprisingly, it might actually be a 30-year-old AI pricing scientist sent straight from a private equity firm in New York.
Yeah, a total culture clash.
And they aren't just there to check spreadsheets, right? They're there to fundamentally rewire how the business operates from the ground up. And I think that image completely shatters the stereotype most of us have when we hear the words private equity.
Well, absolutely.
Because, we usually picture the 1980s Wall Street caricature. Ruthless financiers doing hostile corporate takeovers, stripping assets, and just executing pure, cold financial engineering.
Yeah, that classic narrative of the corporate raider. And look, that definitely dominated a very specific era of financial history. For a long time, the primary tool for generating massive wealth in this industry was, frankly, an aggressive bank loan and just a ruthless focus on the capital structure. The whole Gordon Gekko vibe.
Exactly. But holding on to that image means you're really missing the profound structural evolution the industry has had to undergo just to survive the modern market.
Which brings us to the source material we are pulling from today for you. It's a fascinating book called Capital in the Shadows by Nishant Prabhakar.
It's such a great read.
It really is. It's a remarkably thorough look at the inner workings of this world. It explores how private equity evolved from, relying on clever financial math to actually rolling up its sleeves and mastering operational value creation.
Okay, let's unpack this. How did these firms go from being just financial engineers to the actual architects of corporate transformation?
Well, to really understand that shift, you have to look at why the original math worked so incredibly well in the 1980s and early 1990s. The economic environment back then was essentially a perfect storm for leveraged buyouts.
Right, because interest rates were super high, but there was more to it than that.
Much more. The public markets back then were just riddled with these massive, unwieldy conglomerates. They had severely bloated balance sheets, totally underutilized assets, and crucially, management teams that were operating with very little accountability to their shareholders.
We're talking about that bizarre era where, a tobacco company inexplicably owned a food manufacturer and, an oil subsidiary or something.
Yeah, exactly. And because they were so disjointed, they were trading at massive conglomerate discounts. The market didn't know how to value them.
So the early private equity firms just swooped in.
They did. They exploited that inefficiency brilliantly. And what is crucial to understand about the classic LBO model, the leveraged buyout, is that the debt wasn't just a financing tool to help buy the company. The debt structure was the central investment thesis.
It's basically the ultimate corporate house-flipping strategy, right?
That's a perfect way to put it.
You put down, say, 5% equity, you use massive leverage for the rest, and you don't even necessarily need to remodel the kitchen or fix the plumbing. If you're operating in an expanding market with a bloated asset, the financial leverage just does all the heavy lifting for you.
Right. You just ride the wave.
Exactly. You optimize the capital structure, wait for the valuation to bump up slightly, and because your initial equity check was just so small, your internal rate of return goes through the roof.
What's fascinating here is that the primary source of alpha during this period was almost entirely found in that financial structuring. It was all about knowing how to tranche the debt. It was not about improving the core product or streamlining the daily operations.
They weren't on the factory floor at all.
No, not even close. Look at the RJR Nabisco buyout in 1989. The massive $31 billion deal that got chronicled in Barbarians at the Gate.
Oh, yeah, the ultimate excess.
It really was. It was the absolute peak of this era. It proved that private firms could swallow public whales just using synthetic capital.
But wait, I have to ask. If that house-flipping model, just utilizing aggressive debt structures, was generating such insane returns, why on earth would they abandon it? Private equity firms aren't exactly known for walking away from easy money.
Definitely not.
So did they proactively decide, hey, we want to become operational experts, or did the old math simply just physically stop working?
Oh, it was absolutely a matter of survival. The arbitrage gap violently snapped shut. As we moved into the early 2000s, the whole environment just changed.
How so? Like regulation?
Partly, yeah. You had Sarbanes-Oxley and generally improved corporate governance in the public markets, which meant public companies stopped being quite so bloated. The easy targets disappeared.
Right.
And on top of that, information just became ubiquitous. You no longer had these hidden gems of undervalued assets sitting around waiting to be discovered by some savvy financier. Everyone could see the financials.
And the market itself just became flooded with capital, right?
Yeah.
Suddenly you have 50 private equity firms showing up to the exact same auction.
Exactly. And when you have a crowded market where everyone has access to the exact same debt markets and the same interest rates, well, capital becomes completely commoditized.
Money is just money at that point.
Right. If 10 firms are bidding on an industrial manufacturer and they all have the exact same LBO spreadsheet model, you can't win just by tweaking the leverage ratio. You have to pay a massive premium just to win the deal in the first place.
And when your entry multiple stay high, financial math alone won't generate the 20% returns your institutional investors are demanding.
No, it won't. You essentially have to manufacture the alpha yourself. You have to take a business and make it fundamentally worth more over a 5 to 7 year holding period through sheer ground level execution.
That is a massive pivot. So the people running these firms, the investment bankers, the analysts, the guys building the financial models, they suddenly had to learn how to, what, optimize a global supply chain.
Well, no, not exactly. And that was the hard lesson. They realized very quickly that the skill set required to model a leveraged buyout in Excel is absolutely not the skill set required to run a real-world logistics company.
Right. Those are completely different universes.
Totally different. And that realization drove the great talent shift of the 2010s. Top-tier private equity firms began aggressively hiring a brand new class of professional. They called them the operating partner.
Okay, so who are these people?
These were former Fortune 500 CEOs, supply chain specialists, lean manufacturing gurus, data scientists, people who had actually run things.
Hold on, let me challenge how effective this actually is in practice. Because I'm picturing a former Silicon Valley software CEO or maybe a consultant from McKinsey parachuting into a Midwestern industrial machinery plant and trying to tell a guy who has been running that floor for 30 years how to do his job.
Yeah, it sounds like a disaster.
It sounds like a recipe for a massive cultural revolt.
Yeah.
How do they actually do this without just destroying the company's morale from the inside?
That is the exact friction point that defines modern private equity. They don't just parachute in with a fancy slide deck and start giving orders. The really effective firms align incentives immediately.
By giving them a piece of the pie.
Exactly. They restructure the management compensation so that the legacy plant manager suddenly has a massive equity upside if the new plan actually works. So now they're partners.
Ah, okay, that changes the dynamic.
It does. Furthermore, the operating partners bring a level of capital and urgency that the legacy management rarely had access to under the old corporate structure.
Here's where it gets really interesting, because the private equity firm effectively acts like an elite consulting firm, but with the ultimate authority of ownership.
Yes, that's the key difference.
Because, I mean, a traditional consultant gives you a thick binder of recommendations and then they leave. The PE firm obviously writes the check to fund the new software system, and then, well, frankly, they fire you if you refuse to implement it.
If we connect this to the bigger picture, you can see how value creation shifted from a one-time financial event to this deeply disciplined, multi-year operational undertaking. It's really no longer about just stripping costs to service a debt load.
So what does the actual playbook look like now?
Well, the author, Nishant Prabhakar, outlines a very specific multi-dimensional framework. He breaks it down into 5 core pillars that these modern operating partners use to completely rebuild companies.
Let's dig into the actual mechanisms of those pillars, because I think this is where the modern playbook gets incredibly sophisticated. The first one he mentions is revenue growth, but Prabhakar is very clear that this isn't just about juicing the sales volume, right?
Right, because just selling more units at a lower margin actually destroys value. The operating partners look for strategic revenue quality.
What does that look like in practice?
It means focusing on pricing optimization or maybe expanding into adjacent geographic markets that have higher barriers to entry. Or it's about shifting the product mix entirely toward premium segments where the company has genuine, defendable pricing power.
Which feeds right into the second pillar, margin expansion.
Yeah.
And again, this isn't the 1980s version of margin expansion.
No, which usually just meant mass layoffs and closing plans.
Exactly. Today, it's about applying lean methodologies, actually redesigning the manufacturing workflows to reduce scrap material, and implementing things like zero-based budgeting.
Oh, zero-based budgeting is a perfect example of this deep operational dive.
Explain how that works, because it sounds intense.
It is. Normally, a company takes last year's budget adds maybe 3% for inflation, and calls it a day. With zero-based budgeting, management has to justify every single dollar of expense from absolute zero every single year.
Wow. So you can't just rely on, we've always done it this way.
Exactly. It completely roots out all that accumulated corporate inertia.
That makes a ton of sense. And then pillar 3 is capital efficiency, which I think is honestly one of the most elegant levers they pull, specifically around working capital.
It's a massive source of hidden value. Take a traditional manufacturing company. They might have millions of dollars tied up in bloated warehouse inventory just sitting there. Or they have these legacy contracts that allow customers to take 90 days to pay their invoices.
That's just cash sitting trapped in the supply chain. It's doing nothing.
Exactly. So the operating partners come in, they implement just-in-time inventory systems, they renegotiate the supplier terms to stretch out their own payables, and they aggressively collect their receivables. Suddenly, they've freed up tens of millions of dollars in pure cash flow, and they didn't have to sell a single extra product or fire a single employee.
It's like finding money in the couch cushions, but on a corporate scale. And what do they do with that cash? That leads us directly to the 4th pillar, which is multiple expansion. I love this part because it feels a bit like financial alchemy, but it's driven by real strategy. Explain the mechanism of how they actually change a valuation multiple.
Sure. So a valuation multiple dictates how much the broader market is willing to pay for a dollar of your company's earnings. Let's say you have a stagnant legacy packaging company. It might only trade at 7 times its EBITDA.
Right, because it's boring and slow growing.
Exactly. But an integrated supply chain solutions provider with proprietary tracking software, that might trade at 15 times its EBITDA.
Double the value for the same dollar of earnings.
Exactly. Multiple expansion happens when the operating partners fundamentally change the narrative of what the company actually does. They might acquire complementary software businesses, shift the revenue away from one-off sales to recurring subscription models, and suddenly the next buyer views it as a completely different, higher quality asset.
You didn't just grow the earnings, you changed the very DNA of those earnings so that the market pays a massive premium. That is brilliant. And then the 5th pillar is deleveraging.
Right, which is simply using all that optimized, newly freed up cash flow to aggressively pay down whatever debt is left on the balance sheet, which mathematically directly transfers enterprise value back to the equity holders.
It's a very comprehensive playbook. And today, it seems like the ultimate accelerator for all 5 of these pillars is the digital transformation lever.
Oh, without a doubt. Private equity firms now deploy these highly specialized digital teams just to pull legacy companies out of the Stone Age.
Like getting them off of local servers and onto the cloud?
That's step 1, yeah. But then they use predictive analytics for machine maintenance to eliminate factory downtime. They deploy AI for dynamic pricing.
So an algorithm detects, say, a micro shift in raw material costs, or notices a competitor is out of stock, and it instantly adjusts the pricing across 10,000 SKUs to protect the margin.
Exactly. It's a level of operational rigor that a legacy mid-market company just could never build on its own. They don't have the capital or the talent.
But there is a massive caveat to all of this, isn't there? Because you can have the most brilliant operational playbook, the most advanced AI pricing models, perfect capital efficiency, and it will all completely collapse if you don't have the right human beings executing it.
Yes, 100%. Changing a supply chain is fundamentally about changing human behavior.
And this is where the book dives into what might be its most compelling section. Prabhakar uses India as the ultimate macro laboratory for this exact friction point. If you want to see the modern operational playbook stress-tested against deeply entrenched human culture, you look at the Indian mid-market.
The historical context in India is just vital to understanding this. Historically, the mid-sized companies that private equity targets there were heavily promoter-driven.
Meaning they were basically multi-generational family businesses.
Exactly. They operated on informal networks.
Yep.
Decision-making was entirely centralized. Usually, the patriarch made every single call at the dining room table. And they had a culture that valued loyalty and family ties far above professional, data-driven metrics.
Plus, you have the constraint of the debt markets over there. You couldn't just use the old 1980s LBO playbook even if you wanted to.
No, you couldn't. Indian banks were traditionally very, very conservative about lending for buyouts. So private equity firms operating in India couldn't use massive leverage to juice returns. And on top of that, they often couldn't even secure majority control because these families absolutely refused to sell more than a minority stake.
So think about that setup. If you can't use debt to juice the returns, and you don't have absolute voting control to just fire the management when they disagree with you, how on earth do you generate private equity level returns?
Yeah, it's a huge puzzle.
You have to actually grow the business. But what is the mechanism for making that happen in a traditional family enterprise? You can't just walk in and tell a third-generation founder to step aside.
This raises an important question about diplomacy and governance. The shift required in India was deeply, deeply cultural. PE firms had to pivot entirely to growth equity models. The core value creation lever wasn't just operational, it became institutionalizing the business. It means they had to rely entirely on building trust with the promoters to gradually professionalize the operations.
But how does that conversation actually go? Like, hey, we just bought 30% of your company. Could you please stop hiring your cousins as executives?
Well, it's incredibly delicate, and it's usually done through structural mechanisms rather than direct confrontation. First, they establish a truly independent board of directors.
Okay, so getting it out of the dining room.
Exactly. It creates a professional buffer. It moves decisions into a formal, minuted boardroom. Second, they work to untangle the family's personal wealth from the company's balance sheet, which is a massive psychological step for founders to take.
And then they start bringing in the professional metrics. They introduce formal audits. They hire professional CFOs instead of just using the family accountant. And they establish data-driven accountability.
And a big lever is how they structure the deal itself. They often use milestone-based earnouts.
So the family only gets their full payout if they hit specific operational targets, which basically forces them to accept the new systems if they want to get paid.
Precisely. And eventually, over years, they manage a transition of the founder stepping back to a chairman role while bringing in a professional outside CEO to actually scale the operations globally. Look, if you act like a corporate raider in that environment, if you try to force a hostile takeover, you will be frozen out of the Indian market entirely. No one will deal with you.
So what does this all mean for the industry at large? I think it proves that the modern private equity model is highly adaptable. In India, it acts as this massive engine of modernization, providing the governance and the operational rigor that these family businesses desperately need if they want to compete on a global stage.
It's a complete paradigm shift from where we started. I mean, we've seen the industry evolve from ruthless financial engineers who just relied on rising markets and massive debt into highly disciplined, active stewards of capital. They actually take operational responsibility for the assets they buy.
They've really had to become the architects of the businesses they own. We've covered a massive amount of ground today for you, from the closing of the arbitrage gap to the deployment of AI on the factory floor and that incredible cultural tightrope walk of professionalizing family businesses in India.
It's been a journey.
It has. But as we wrap up our analysis of capital in the shadows, there is a profound challenge on the horizon for this industry that we have to talk about.
Yes, the question of the next frontier. This is what keeps PE partners up at night. If we look at the last 20 years, private equity has perfected the optimization of tangible, physical operations. Factories, supply chains, working capital, traditional cost structures.
Stuff you can touch.
Right. But the global economy is fundamentally shifting. We are moving rapidly into a future where a company's greatest assets are increasingly intangible. We're talking about proprietary data sets, network effects, brand equity, and highly specialized human talent.
Which raises the ultimate question. How do you apply the rigorous private equity playbook to a company whose most valuable assets aren't heavy machinery, but ideas and people that literally go home every night at 5 p.m.?
Exactly. You can't just lean out a data set the way you lean out a warehouse.
The traditional tools of value creation are going to have to be completely reinvented all over again. Thank you for joining us on this deep dive into capital in the shadows. Keep questioning the narratives behind the world of high finance, and we'll see you next time.